Hey there, it's Sue Richey, and today we have a tax expert that is joining us on a webinar that we are doing for our clients and for the general public on taxes and some surprising things that a lot of landlords may or may not know. And I'm sure you're in the midst of tax season, so here's the long conversation we had, and I hope this brings some value to you as well.
Good afternoon, everybody, and thank you for being here. My name is Calvin McGettigan. I'm the Business Development Manager at Richey Property Management, and I will be your host today. Before we dive in, here's what you can expect. This session will run about 1 hour. The presentation will roughly take 40 minutes, followed up by a live Q&A. We are recording this and we will send a replay afterwards, so no pressure to catch every word. And now today is fully educational, no sale pitches coming your way. Our goal is simple: help landlords and investors understand tax rules so that where that often create confusion and unexpected outcomes. Now, to make this valuable for you, please use the chat. If questions come up, drop it in. You don't need to wait until the end. Now, could I get a quick show of hands or simply type yes into the chat? Have you ever been surprised by a tax result related to your rental property? All right, good. Now you're in good company. We host these sessions because we see the same disconnects over and over. Smart investors, solid properties, but misunderstandings about timing, losses, and long-term tax impact. This afternoon is about turning confusion into clarity and helping you walk with better questions, not more stress. And if anything else, we promise fewer, wait, what? Moments. So why do we host these events? So we host these events for three simple reasons. First, education over selling. We believe informed landlords make better decisions and better decisions lead to better outcomes over time. Second, we want better decisions compound. One misunderstood tax rule can quietly cost the landlord tens of thousands of dollars over the life of his portfolio. And third, alignment matters. When property management and tax strategy are aligned, things tend to go smoothly. So when they're not, surprises show up, usually at the worst possible times. Our goal today is to help close that gap. Think of this afternoon as fewer surprises and fewer "why didn't anyone tell me this" moments. And now where planning meets property management. This slide explains why we believe property management and tax planning can't live in separate silos. Your CPA typically sees a tax return once per year. We see the property all year, the timing of expenses, improvement, repairs, vacancies, and who's actually doing the work. Records, timing, and documentation don't just affect operations, they directly affect tax outcomes. So when those realities don't match what's reported, that's when confusion and frustration creeps in. In other words, the IRS doesn't care about how busy you felt, they care about what can be proven. And now, next slide. So these are some common landlords disconnects we see. These are phrases we hear all the time from very smart landlords. I lost money. Why do I owe taxes? My CPA didn't mention this. I wasn't planning to sell yet. None of these mean someone did something wrong. They usually mean the difference between cash flow, tax rules, and long-term planning wasn't clearly understood up front. This afternoon is about closing the understanding gap. If any of these thoughts have crossed your mind, congratulations, you're normal. And now next slide is about our market. So Northern Virginia landlords operate in a very specific environment, as most of you are well aware. We see high W-2 income households, which changes how rental losses and deductions work. We see strong appreciation, which builds wealth, but also creates future tax consequences. And we see a lot of absentee ownership and frequent relocations due to careers, military, government service. All of that makes tax planning here more complex and more important. So great area to own a property, slightly less great if you assume the tax rules are simple. And now, what do the best landlords do? So the most successful landlords we work with don't necessarily know more, they plan earlier. So they start the tax conversations well before the year end. They ask better questions, not just what should I do, but why does this matter? And they build professional teams that communicate with each other. The coordination is what turns real estate from stressful into strategic. And no, Googling tax strategy at midnight does not count as planning. So the key takeaways from this opening is if you take nothing else away from this afternoon, take this. Education leads to better decisions. Strategy works best when it's proactive, not reactive. And professional partnerships matter most when they're aligned. You don't need to be the master of the tax code. You just need to understand enough to ask the right questions at the right time. Now, before I hand you off to Olivia, I do want to just introduce some folks from our team. So I'd first and foremost like to introduce Sue Richey. She is our owner, and she is moderating this event. She has spent years helping landlords build long-term sustainable portfolios, not that you could tell by her picture. And we have David Buckingham on here, who is our operations manager. He lives the day-to-day details of this company, and whenever there's something major going on, he will be the man to help fix it. And then we have Evelyn Mazziala, who is our business development manager lead. She works closely with our landlords, navigating both their growth and their finances. And we're all here as resources if you need.
Yep, we're glad you could join us today. We've got a lot of good information coming up. So thanks for being here.
And with that, I'm excited to introduce Olivia Melton. She's a CPA tax manager at Wendroff Associates. Olivia works with real estate investors every day and specializes in explaining not just what the rules are, but why timing and structure matter so much. She's going to walk us through the tax rules that most often surprise landlords and investors. So Olivia, thank you so much for being here, and I'll turn over to you and your very insightful information.
Thank you so much, Calvin. I'm very happy to be here today, and thank you all for attending. Just a brief little introduction to myself. I am a tax manager at Wendroff and Associates, and I have been in the tax field for about 15 years now. And a portion of that time, I was also a tenured professor of accounting at Augustana College. So explaining tax rules comes pretty naturally to me. So hopefully I can provide you some value today. So before we get into specific rules and strategies, I want to take a few minutes to frame what we'll be covering today. So if you've invested in stocks, bonds, operating businesses, you may be used to a fairly straightforward relationship between income, deductions, and taxes. Real estate doesn't always behave that way. So it operates under a different set of assumptions, and those assumptions drive everything we're going to talk about today. At the core of this discussion is the distinction between passive and non-passive income. So understanding that framework is fundamental in understanding how real estate may impact your tax strategy. We'll also spend some time talking about depreciation because it's the engine behind most real estate tax outcomes. Depreciation benefits most investors, but not always immediately and not always in the way people expect it to. From there, we'll also talk about acceleration strategies. Those tools can be very powerful, but they don't exist in a vacuum. So it's important to understand when acceleration helps and when it doesn't. We'll also address some the real estate professional status, which changes the rules in specific situations and can significantly change your tax outcomes. And then finally, we'll talk about risks and trade-offs. Real estate tax planning is not about maximizing your deductions at all costs. It's about making informed decisions early, understanding how the decisions you make today are going to affect future years, and avoiding strategies that might look good on paper, but then don't hold up in practice. So the goal today is not to turn you into tax experts by any means. It's just to give you a framework for understanding why real estate behaves the way it does under the tax code and how thoughtful planning can change the outcomes over time. So tax planning works best when it's proactive, coordinated, and aligned with long-term goals, not when it's reactive and driven solely by the current year's tax bill. So we're not here to talk about tricks or loopholes or any aggressive tactics. We're just here to understand why real estate is treated differently under the tax code. Okay. So real estate is one of the very few asset classes, where Congress has intentionally built incentives into the tax system. So those incentives are not accidental, they aren't temporary, they reflect long-standing policy goals, right? To encourage housing, encourage development, long-term ownership, and capital investment. So depreciation is the most visible of those incentives. It allows property owners to deduct the cost of a building over time, even though the property may be appreciating in value. And that alone seems counterintuitive to many people, the idea that something you have going up in value can still generate tax deductions. But what really makes depreciation powerful is that it's a non-cash expense. You don't write a check to the IRS or anyone else in order to claim that depreciation. It's a deduction tied to ownership, not to cash outflow. And so that creates opportunities, but it can also create some misunderstandings as well. One of the common assumptions that we hear is if I'm depreciating my property, my taxes should be going down every year. And that's not necessarily true. Depreciation doesn't automatically reduce taxes. It creates potential tax benefits. And whether those benefits are usable depends on how the activity is classified, when the deductions occur, and how they interact with the rest of the taxpayer's income. So that distinction is critical. So throughout today's discussion, I want you to separate the existence of a deduction from the usability of the deductions. Okay, the tax code is full of deductions that exist on paper, but don't reduce tax in the current year. Okay. So the benefits often don't show up cleanly or immediately, but when they're coordinated properly, they can be powerful over time. So now that we've talked about why real estate planning works a little differently, the next step is to look into the actual rules that create those differences. So real estate doesn't get special treatment because of creativity or clever structuring. It gets special treatment because Congress wrote very specific rules into the tax code. And those rules drive what we're going to discuss today. So before we talk about depreciation, acceleration, professional status, we have to start with the foundation, how rental real estate is classified under the tax code, because classification determines everything that follows. So by default, rental real estate is considered passive under IRS rules. Passive income and passive losses live in their own silo or their own bucket, right? So passive losses can offset passive income within that same bucket, but passive losses generally cannot offset W-2 wages, professional income, or active business income. And this is where frustration often starts, is taxpayers frequently assume that their effort is going to equal tax treatment. They say, I spent time on these properties, managing them or working on them, so it shouldn't be passive. But the tax code doesn't really work that way. It doesn't measure how busy you feel. It measures how the activities are defined and classified. So once you separate the effort from the classification, the rules may start to make a little bit more sense. So passive doesn't mean unimportant. It doesn't mean you're completely hands-off. It's simply a tax category. And there is one commonly misunderstood exception that comes up here, and it's the $25,000 special allowance for rental real estate losses. Now, this rule allows up to $25,000 of rental losses to offset non-passive income like W-2 income if certain conditions are met. So first, the taxpayer has to actively participate in the rental activity. And second, they do have to own at least 10% of the value of all interests in the activity at all times during the year. There are some limitations, however. So for example, a taxpayer who owns rental real estate through a limited partnership interest generally is not going to be considered to be actively participating for the purposes of this rule. But more importantly and more common is the income limit. So the $25,000 allowance begins to phase out once your modified AGI exceeds 100,000 and is completely phased out at 150,000. So this phase out is straight line over that 50,000 range. For many professionals, and especially for dual income households, that means the exception is either partially phased out or completely phased out. So that's why many people hear about this rule and they expect it to apply to them, and then they're disappointed come tax time when it does not. So this rule does exist, but a large portion of high earning households, it's irrelevant. Okay. So for most higher income investors, losses will be deferred or suspended for years. Okay. So that's why timing planning is so important in understanding this. Next slide, please.
Okay.
So let's talk about why many rental losses don't reduce taxes. Okay. And again, this is a common frustration that we hear in real estate taxation. I have a loss this year. Why didn't my taxes go down? Now, the primary driver of these losses is usually depreciation. Depreciation deductions frequently exceed the net rental income. So on paper, you have created a loss, even if the property is cash flow positive. However, because the activity is classified as passive, that loss is typically suspended. And suspended losses can be misunderstood. This doesn't mean that the loss has been denied. It doesn't mean the loss is lost and it expires. It is carried forward indefinitely. So the IRS is essentially saying, we acknowledge you have this loss. You just can't use it now. You can use it later. Okay. So it's helpful to think of suspended losses as a deferred tax asset that kind of sits on the balance sheet of your tax return, waiting for a triggering event. So those triggering events are usually one of three things. The future passive income is generated. There's a change in classification or a disposition of the property. And this distinction matters because some investors will assume something has gone wrong when they don't see an immediate tax benefit. In reality, the strategy might be working exactly as it was intended to. It's just on a longer timeline. So you don't want to make bad decisions because you don't understand what's happening here. The tax code is very explicit about this. Passive losses are deferred by design. Real estate rewards patience, coordination, and long-term planning.
And
Before
Olivia,
we move on, are there questions? Yeah, go ahead, Calvin.
just going to say, yes, we do have our first question. It comes from one of our wonderful clients, Tanya Courtney. She said, what is participating or limits? Do you get the 25K back for all years when your income finally reaches below the 150K? So that was for the previous slide, but in reference to the 25K.
Yes, it's up to that amount each year when you meet those qualifications. I, I hope that answers.
I'll let Tanya answer in the chat if it does. Well, good question, Tanya. Thank you. Oh, she said no.
No. Okay, let me open the chat here real quick.
Tanya, if you want to unmute yourself and just, ask a question or do
Okay,
follow-up
thank
questions.
you. So I have heard this from my tax preparer, and she is a CPA, and so she says that she's told me that $150,000 limit. So I just retired. Am I going to be able to capture all those $25,000 for each year in the past? And what is the level of participation that an owner has to have? If you have a property manager,
Okay, great question. So participation here for this rule, it's not like material participation. The bar is much lower here. So this can include approving tenants, setting rental terms, authorizing repairs, being somehow involved in those management decisions, even if you've hired somebody else to do the day-to-day management of the property. In terms of whether you can take the past losses, I actually don't recall that off the top of my head, and I don't want to give you incorrect information there. So that's something I can follow up on.
please, because you're saying that you get the rewards, it's designed to get it later. But if annually you would otherwise be able to claim that 25,000, then when do you get it?
We'll get to that. Yeah, for sure. It doesn't just go away.
I'm making a list of things like that, and we will get answers and we'll send follow-ups to everyone.
Perfect. All
Thank
right. Thank you, Olivia. Thank you, Tanya.
Okay. Yep. There you go. So now I want to get into a little bit more on the planning side. So depreciation can be used as a planning tool. Now, remember, depreciation is a non-cash deduction. It is based on the cost of the asset and the useful life of the asset. But I do want to be very precise about what can and cannot be controlled when we're talking about this. So you don't get to choose whether or when depreciation is taken once a rental property is placed in service. So depreciation begins when the property or a component of the property is placed in service. So that means it's ready and it's available for its intended use as a rental. From that point forward, depreciation follows a prescribed schedule. What can be planned then is when are the assets placed in service and what is included in that placed in service date. So this matters because rental real estate can be front loaded when you use acceleration strategies. But once depreciation starts, it runs whether or not it's optimal from a tax standpoint. Okay, so the planning happens before acquisition, before renovations are completed, and before a property is available for rent, not when you file your taxes at the end of the year. Okay. Another important distinction is rental real estate. In rental real estate is that the depreciation is tied to use, not to ownership. So buying the property doesn't trigger the depreciation. Making it available for rent does. Okay, and that distinction is important, especially if you have construction projects or value add renovations, those types of things. So good planning is going to ask questions like, when will this property realistically be available for rent? Are there major components or improvements that could be placed in service separately from the rest of the property? Is income expected to be unusually high or unusually low in the year depreciation begins? Or is this property intended as a long-term hold, or is there a shorter exit horizon? Okay, those are all questions that you should be asking ahead of time, not when it's time to file your tax return. Okay. Rental depreciation interacts with other rules as well, like the passive loss limitations, net investment income tax, and depreciation recapture. So once depreciation starts, you're committing to a timeline that affects not just the current year, but every year until disposition. So when we talk about depreciation as a planning tool, what we're really talking about more is placed in service planning, right? So the goal isn't to delay arbitrarily depreciation deductions or accelerate it blindly. The goal is to align the start of depreciation with your broader financial picture. And oftentimes taxpayers think that there is that depreciation can be optimized retroactively, that you can get to tax time and then suddenly make some decision that's going to optimize it. And a lot of times that is not the case, because once depreciation starts, once it's placed into service, it follows that prescribed timeline. Okay, and something to keep in mind here is high income years often benefit the most from accelerated depreciation, but that depends on your classification, which we'll get to here a little bit later on.
I have a
Next
quick
slide,
question
please.
for you.
Oh, sure.
So I know depreciation is just one piece of the overall puzzle in terms of tax planning and strategy and rental properties. When someone has fully depreciated a property and has held on to it for a long period of time and there is no more depreciation, right, to take, what would be, again, just generally, is it a good thought process to say, okay, let's sell this property and purchase something else that can start that over? Or, and again, there are other factors, of course, everybody's situation is different, but just in terms of depreciation as a piece of this, um, just wondering what your thoughts are.
Not necessarily. Not necessarily. So there is the factor of depreciation recapture when you sell a property, depending on your exit strategy with that property. So that could play a major role in that. You also may have a situation where the depreciation as you've taken it has consistently meant you're operating at a loss, at least on paper, you're operating at a loss. And now if depreciation, you're done, you're fully depreciated, it may be now that those losses, those suspended losses come into play and are used to offset the income now.
You're right.
So it
And
really
recapture
depends
is
on the
something
specifics.
important to consider as well. Yeah.
Yes. Yep.
And we also have a question in the chat from another one of our good clients, Conrad Tribble. He said, a practical question. Typical depreciation for a house is 27.5 years. If you place a house in service during, let's say, 2025, does it start counting from the actual month it's placed in service, or does 2025 count as the first full year, no matter what month it was placed in service?
Great question. So it counts the month you place it in service. So real estate follows what's called the mid-month convention. So whatever month you place it in service, it's considered to be placed in service the middle of that month. And you calculate depreciation based on that. So if you put it into service December 2025, it does not mean you take depreciation for the whole year of 2025. It means you get half a month of depreciation for that year. Okay.
And
Great
how would
question.
this work can you start depreciating a property? Let's say you only rent your property for 5 years, like if you're in the military or something and you're only gone for 5 years. Are you allowed to depreciate for those 5 years and move back, or how does that work?
Um, so you do have to depreciate it if you are renting it out. You're required to depreciate it. There may be a pause in depreciation if you come back to it and say it's not a rental anymore. Now you're living in it. And then the depreciation recapture is still going to apply when you ultimately dispose of that property.
Okay, okay. And we have one more question as well. Does depreciation stop at 0 years?
Uh, I think I understand what this means. Once you've fully depreciated it, meaning you've depreciated it over, say, the 27.5 years.
Or at 30 years? Sorry, pardon me.
30 years. So the depreciation stops when when you've gone through the whole useful life. So if it's rental real estate and it's 27.5 years, once you've been depreciating for 27.5 years, yes, it's stopped. It's fully depreciated. There may be other components that are still being depreciated. So things like if you purchased all new appliances or a new roof, something like that. Another question, great question. The depreciation amount for that specific asset generally remains the same. Then other components are depreciated separately. So if you have a property, you started depreciating it, that depreciation remains consistent. And then if you have some like qualified improvement, that would be kind of considered its own separate asset with its own depreciable life that would be depreciated separately.
And
I
that
hope
would be
that
things,
helps.
roofs, new kitchens, like capital investments that improve the property.
Yes. Yep. Um, And without getting too into the weeds here, I guess, there are some variations when you're talking about assets outside of the real estate. So other assets are depreciated on they're not depreciated on straight line. So real estate is depreciated straight line. And then So it's kind of the same each year. Other assets may be under maker's depreciation, where the depreciation early on in the asset life is more than depreciation later on in the asset life. So it does kind of change depending on the asset you are talking about. So it would really depend. Depreciation recapture may apply. Even if you move back in a house for longer than you rented, it would ultimately depend on the overall gain and how much of that gain is excluded under the sale of principal residence rules. So that would be a very specific planning that you would want to go over with your CPA or tax advisor with your specific scenario.
Like the fine folks over at Wendroff Associates.
I moved I moved a little early. We had a lot of questions about depreciation, but it's a good segue into what you're talking about next.
Yeah, for sure. So to get into some of these more advanced depreciation topics, the one thing I want to talk about is cost segregation. And some people may have heard of cost segregation studies. It might be entirely new to you. So I apologize if I'm saying something you already know. But this can sometimes be a misunderstood rule or tool for tax planning. So when you have a cost segregation study, it does not create new deductions. It accelerates depreciation that already exists. So buildings, we all know, are made up of different components, and not all of those components wear out at the same rate, right? And the tax code recognizes this. So things like flooring, wiring, lighting, cabinetry, those types of things, certain land improvements, they don't have the same useful life as the structure itself, the building shell. So a cost segregation study comes in and they identify those components and they reclassify them into shorter recovery periods. So the result is faster depreciation, typically front-loaded into the early years of ownership. So that acceleration can be very powerful, but you do have to view it in context. So the acceleration is going to magnify outcomes. If the deductions are usable, it accelerates the benefit. If they're not usable currently, it accelerates the deferral of those losses. Okay? So neither outcome is inherently wrong. It's just you need to plan accordingly. Cost segregation is not an automatic win. So you should evaluate it alongside your income levels, how long you expect to hold the property for, your exit strategy, et cetera.
And it doesn't make sense to do really a cost segregation study really towards the tail end of that period because you've already
correct
appreciated everything.
Yes, it doesn't necessarily have to be done before you start depreciating the property. You know, if you put say you put a rental into service last year, and now you think maybe you want to do a cost segregation study, it's still possible to do it now. But 10 years down the road, no, not helpful, because most of these items that they'd be kind of separating out have a useful life of like 5 to 7 years.
Perfect. And we did get one additional question just before you move on about depreciation. It was from Bob Lucer.
Do you want to read the question, Calvin?
Oh, I think Lydia's got it.
I know she's reading it. Looks long.
Yeah. And for those not in the chat, just if a property is fully depreciated and do not purchase, then is the sale price fully taxable, added to income or something special? I'll let Olivia go ahead.
So that would kind of depend on the specifics of the scenario. So if you didn't purchase the property, was it inherited? Was it gifted? That kind of affects your basis in that property. It is pretty rare to have a zero basis in a property. And so that would be something where you would need some more detail there and to go over the specifics. And then a Section 1031 exchange to purchase another property. The values do have to be similar, but the specifics on the Section 1031 exchange are kind of outside the scope here of what we're getting into today. What is the fee for cost segregation study? So a lot of the cost segregation studies, the companies that do them will generally offer a free cost benefit analysis. So they'll take a look at it for you to see if it's going to actually benefit you before they go through the whole process of the study. I'm not exactly sure on the fees. It depends on which firm you use to do that.
I think I
And
want to say it's a couple $1,000. I feel like I looked at this and it's somewhere in that ballpark, but I don't know for sure.
And at what price point or market value of homes does it make sense? I would say cost segregation isn't so much about the price point or the market value. It's more about your specific tax situation and whether those accelerated deductions are going to be useful to you and what your horizon is in terms of how long you're going to hold on to that property.
Okay.
All right. So moving on to something you may or may not know, part of the One Big Beautiful Bill Act, which was our big tax law that was signed into law last year, has many, many different components to it, but the one I'm particularly interested in is the 100% bonus depreciation. So this new law permanently restored 100% bonus depreciation for qualifying property placed in service after January 19th, 2025. So that's a significant shift from the phase down percentages that we've seen in recent years. If this hadn't been signed into law, the rate for 2025 would have been 40% for the whole year. For qualifying property that was placed in service between January 1st and January 19th of 2025, that rate is still 40%. But for anything after January 19th, that rate is 100%. So just like cost segregation, the bonus depreciation doesn't change what can actually be depreciated. It changes when you're taking that. So it allows qualifying components to be written off immediately rather than over time. So if you were to combine this with a cost segregation study, this could create some extremely large first-year deductions. However, you have to consider, does that large deduction equal better results for you personally on your individual tax return? It amplifies kind of whatever strategy you have in place already. And if you use bonus depreciation and you don't have a good strategy or the deduction is not useful to you currently, it can simply accelerate the losses with limited benefit, and those losses would then get deferred. So again, this is, excuse me, why coordination matters so much. Okay, next slide. So let's get into some examples of when you may be able to actually currently use the losses. And this may apply to some of you, it may not, or it may apply to some people you work with if it doesn't apply to you personally. So you may have heard about what's called the real estate professional status. And this kind of changes the rules in relation to real estate taxation. So when a taxpayer qualifies for this status, rental activity can be treated as non-passive, and that's a huge deal. That means that can allow losses from the rental activity to offset other income like W-2 income or active business income. So when it applies, the impact can be significant, but the rules are strict. So there are 3 requirements, and all of them have to be met. So more than half of your total working time has to be in real estate activities. At least 750 hours have to be spent in those activities, and you must meet the material participation tests. So in this case, title doesn't matter, licenses don't matter, ownership alone doesn't matter. It's related to the time, the activities, and the documentation. And the real estate professional status applies at the individual level, not at the property level. And this is highly scrutinized by the IRS. So this is not something that's automatic. It's something that you need to look at carefully to see if it applies to you. And the worst outcomes occur when you assume that this is going to apply to you, when in actuality, it does not apply to you. Okay. Let's get into a little more detail on the material participation. Okay, so even after you might meet those time tests for real estate professional status, you also have to meet the material participation. This is kind of a separate hurdle, and this one often causes some problems. So material participation is the IRS's way of asking, was the taxpayer truly involved in the operations of the rental activity on a regular, continuous, and substantial basis? Okay, so by default, each rental property is treated as a separate activity. So that means material participation is tested property by property, unless you make an election, which we'll talk about here in a minute. So the default treatment is where a lot of times the real estate professional status claim breaks down, because hours get spread across multiple properties. You're spending a few hours on this one, a few hours on this one, and no single property meets this threshold. So on paper, the taxpayer worked a lot, but under the rules, they didn't materially participate in any one of these activities. So the IRS provides 7 different tests for material participation. You only have to meet one of them, but you do have to meet it clearly and consistently. I'm not going to go into all 7 tests. I'll just talk about a few of the common ones. So the most common test is the 500-hour test. So if you participate in the activity for more than 500 hours during the year, you satisfy material participation. So again, this is straightforward in theory, but can be a little bit more difficult in practice when multiple properties are involved. Another common test that is that participation constitutes substantially all of the participation in the activity. So this is relevant more for smaller portfolios or single property owners, but it requires that the taxpayer essentially be doing everything themselves. Okay. And then there's also a 100-hour test, and this is where the taxpayer participates for more than 100 hours and no one else participates more than the taxpayer. Okay, so this one, some people get confused or fail this status because maybe they have a single individual cleaner that spends more time than them on cleaning the property. Sometimes that can be planned around by, for example, having a team of cleaners instead of one individual cleaner. So this applies on an individual basis. It does not get aggregated. For example, if everybody works for the same company, we don't aggregate that time for that company. It's still on the individual basis. Now, something else to keep in mind is not all time counts equally. So investor level activities generally aren't going to count towards material participation. So this might include things like meeting with brokers about acquisition discussions, reading market reports, analyzing potential acquisitions, performing due diligence on a property that you haven't yet purchased. Those activities are important, but they're not operational. So what does count for material participation is the day-to-day operational activities like managing tenants, coordinating repairs, supervising contractors, approving expenses, that type of thing. Now, hiring a property manager doesn't automatically disqualify you from material participation. That's a misconception. You can still materially participate while using a manager as long as you're still meeting the applicable thresholds. And again, that, for example, no one else participates more than the taxpayer. Again, that's on an individual basis. So if you hire a property management company and there are multiple individuals in that company working on your property, as long as you have spent more time than each of those individuals, you're good. The time does not get aggregated to as the company as a whole. Okay. Now, grouping elections are where planning becomes essential. So taxpayers can elect to group multiple rental properties into a single activity for purposes of the material participation rules. So when done properly, that means the hours across the properties can be aggregated. So if you own multiple properties and you're spending, 50 hours on this one, 20 hours on this one, another 70 on this one, you can aggregate those to be over that 100 hours for that particular test. Now, grouping elections are not automatic. They have to be made intentionally, they have to be documented and applied consistently. And once made, they generally bind future years unless your facts change significantly.
Okay.
Now, with the real estate professional status and material participation, this offers a really cool household planning opportunity. If this status applies to one spouse, okay, then you can potentially offset the other spouse's active income with rental losses. So it's important to keep in mind that the one spouse does have to qualify. So you can't pool hours between spouses. The qualifying spouse has to independently meet the tests for this real estate professional status. And then that would allow you, if the one spouse is a real estate professional and the other is a W-2 employee, if you have losses on the rental real estate, you can offset the W-2 income, reducing your overall household taxable income. Okay. Documentation is where all of this either holds together or falls apart. The IRS and tax court consistently reject vague or reconstructed or estimated time logs. So you can't just say, oh, I worked on it most weeks. Best practices is contemporaneous documentation. So calendars, logs, emails, narratives that are tied to specific dates and activities. And generally a well-supported claim for a real estate professional status isn't going to rely on a single spreadsheet. It's going to be these various sources of documentation that tell a consistent story that matches the taxpayer's lifestyle, their income, and their property operations. So this is why oftentimes these types of things seem good on paper, but then it doesn't survive the scrutiny in practice. You have to align the facts, the documentation, and your expectations.
Perfect.
I do want to take some time to talk briefly about the net investment income tax, because this is an area that is often overlooked in planning, and it applies whether you have real estate income that's considered passive or you qualify for real estate professional status. You should never overlook this component. So the net investment income tax is a 3.8% surtax that sits on top of the regular income tax system. And because it's not part of the standard rate tables, it frequently gets overlooked in planning, even though it can affect your after-tax returns. So the net investment income tax generally applies to individuals, estates, and trusts with income above certain thresholds. So for individuals, that's $200,000 for single filers, $250,000 for married filing jointly. And once those thresholds are exceeded, the net investment income tax is going to apply to the lesser of net investment income or the excess of modified AGI over the threshold. So what counts as net investment income is the key question here. So net investment income generally includes interest, dividends, capital gains, and passive income from businesses and rental real estate. So that means for a high income household, passive rental real estate income is going to fall squarely in the net investment income tax base. So for an investor that's passive in real estate, it can be taxed. Any income produced by that rental activity can be taxed at the ordinary income tax rates plus an additional 3.8%. And people often forget about that additional layer. And this tax also applies to capital gains when the property is sold. Now, the net investment income tax follows classification, not ownership. So if the rental activity is passive, income is generally subject to the net investment income tax. If the rental activity is non-passive due to the real estate professional status, then net investment income tax won't apply to that rental income. So it does affect those after-tax cash flows. And another nuance of this is that if you have a suspended passive loss, it does not offset your net investment income tax in the year it's generated. So if the loss is not allowed under regular tax purposes, if it's suspended to future years, the same applies for the net investment income tax. So net investment income tax generally isn't going to change your strategy, but it does change the math. And so ignoring it can lead to overly optimistic projections or unrealistic expectations.
And there's some questions in the chat for you, Olivia, if you want to.
Let me see. Let's find the last one. If the property was taken out of service. So typically what would happen when you do a big renovation is that renovation itself would be a qualified improvement, and that would be kind of treated separately from the original property, and it would be depreciated separately. And when it's placed into service, when those renovations are complete and ready, that's when it would start being depreciated.
Perfect.
Material participation applicable. Yes, it's applicable for 2025. The material participation rules have not changed recently, so those apply to all recent tax years. Section topic 701 capital gains exclusion apply to home sale. I am not certain on that one. So that's one I can follow up with on the topic 701. Is net investment is net investment income tax new? It is fairly new. I want to say it was part of the 2017 tax bill is when that came into play. So it's not new with this most recent tax bill, but in terms of overall, it is fairly recent.
Awesome.
All right, we have a little bit of time to maybe get into some potential pitfalls. I'll speed it up here a little bit. Depreciation recapture is an area where we see a lot of people who end up with a surprise, very large tax bill that catches them completely off guard. So depreciation is really useful, but it's usually a timing benefit. It does not permanently eliminate tax. So when a property is sold, the IRS looks back at the depreciation that was claimed and requires some of that to be recaptured and taxed at ordinary rates, not at the capital gain rates. And that is because when you originally took the depreciation, you got to use it against or income taxed at ordinary rates. So the faster the depreciation is taken, the more potential recapture is created later. And that doesn't necessarily make accelerated depreciation bad. It does, however, make exit planning essential. Okay? Timing matters, income levels matter, the transition structure, the transaction structure matters. So selling in a low income year versus a high income year can substantially change your tax outcome here. Now, suspended losses. So if you've been a passive investor and each year you see these paper losses and they build and build and build, you've been like, when do I get the benefit of these? This would be one of those times where they're released. Suspended losses would be released upon the disposition and can offset the gains. So that's something else you also want to factor in to your exit strategy. You can also consider things like Section 1031 exchanges, reinvestment strategies, and even estate planning. If you want to hold on to that property long term, those can all change how and when the tax is recognized. So you really have to discuss exit strategies before you get under contract. You know, I had a client come to me last month. They had a closing date and they said, how can I reduce my tax liability here? I said, well, it's a little bit late for that. There's not much I can do after you're already under contract to sell this property. So talk about the exit strategy early. Don't leave it until you've actually sold the property and get hit with a huge surprise tax bill. Okay.
Perfect.
Next slide. It's also important to talk about some of the risks and trade-offs here. And this isn't because real estate tax planning is particularly dangerous or risky, or we're talking about things that are really aggressive tactics. It's just that the strategies that we've discussed only work if they're grounded in facts and are supported by documentation. So a lot of real estate tax strategies don't fail because they're abusive. They fail because they're misapplied or they're poorly documented or they don't match the taxpayer's actual behavior. Several of the areas we've talked about today are well-known audit focus areas. So the passive loss limitations, the real estate professional status, material participation, bonus depreciation. None of those are fringe concepts. They're all very clearly allowed by the tax code, but because they can materially affect tax outcomes, they also receive increased scrutiny by the IRS. So a misconception is that the risk only exists when the deductions are large, when in reality, the risk increases when documentation or when deductions don't really align with the underlying facts and documentation. So a modest deduction that's unsupported can be more problematic than a large deduction that is well documented. So again, that documentation is so important. You have to have those contemporaneous records. Don't estimate. Sorry, I'm trying to skip over things. I know we're just about out of time. Another thing to consider is state tax. State tax conformity is an issue that often gets overlooked. Not all states follow federal tax law, especially surrounding depreciation and bonus depreciation. So that's something you want to make sure that you are not ignoring when you think about your tax plan. And remember that good planning is not always about maximizing deduction. It's about aligning your tax outcomes to the economic reality. And not all strategies are going to fit every investor, and that's okay. All right, next slide. Okay. So again, real estate offers some really powerful tax benefits, but those benefits depend on classification, they depend on timing, and they depend on planning. There are some areas you want to make sure you're not overlooking, such as the state tax laws and the net investment income tax. make sure you're documenting everything. Remember that the most effective tax planning works before decisions are made, not when it's time to file the return.
Yeah. And if you want to, we can jump straight into the Q&A if you still have time, Olivia, and if people here want to stick around, we can do a quick questions and answers. If anyone has specific questions, please speak now and we'll go through them relatively quickly. Don't be shy.
I have a question, and I have to go soon. So I
You
have a
sure?
property. I have a property that it's been out of service for sadly 2 years. I was trying to do renovations. I did major renovations. I just put it into service on Monday. And you said there's this bonus depreciation. And I'm curious, one, if I can, based on what you said, write that off on my 2026 returns, or the returns that, yeah, 20. Well, I don't know if it's 25 or 26, but then if I want to sell it, would that be a smart thing to do because of capital gains and what I'd have to pay? And also, if my salary decreases, would that be beneficial?
So I can answer some of that in a general sense, but it sounds like a lot of your questions are very specific. You would definitely want to meet with a CPA or tax advisor. But in terms of bonus depreciation, it does apply to qualified property. Depending on the renovations you did, that property may or may not be qualified property. So you would have to look a little bit closer into that. If you are looking to sell soon, it's generally not a good idea to accelerate the depreciation because then you will get that depreciation recapture shortly after. So typically, we don't encourage accelerating depreciation when you are close to selling that.
Yeah, that's what I thought.
Perfect. Thank you, Tanya. Any other questions?
Hey, this is Conrad. Can I throw a question in here?
Yeah, please, Conrad.
For I mean, maybe value for others, but you had a rental house for several years, like us. You know, maybe you're coming back and forth. If you move back into the house, I think it's 2 years out of the 5, then you can essentially reconvert it to a primary residence and then sell it as a primary residence instead of as a rental property. Is that true? Is that correct? And if you do that, are you essentially neutralizing the depreciation recapture requirement that you would have if you sold it as a rental property?
Not necessarily. So yes, it's true that you can convert it back to a principal residence, sell it as a principal residence where that exclusion would apply for selling a gain on the sale of a principal residence. Depending on the amount of the gain, there may still be some depreciation recapture that occurs in that situation. So you would definitely want to take a look at the actual numbers and estimate of what that gain would be before going through the sales process to get a good idea of what that tax bill would look like.
Okay, thanks.
Yeah,
Yeah.
I like that question because, like, in my brain, it's always been, future thought, like, oh, go buy my future retirement at the beach and rent it out, and then sell and move in and make it my primary. So I can just avoid all the capital gains taxes. But from my understanding, is they fixed that and they're not letting you just get away with avoiding all the capital gains taxes.
No.
Then you have to keep it till you die, and then your kids can figure it out.
So then maybe
That
it's
is an
better
option.
or it's better to do all kinds of renovations to offset past depreciation.
Possibly. I mean, it depends because then you are also having a big cash outflow with the renovations. So it's something you need to look at carefully with the kind of cost benefit analysis.
But if it's already done and you do renovations, that will offset the past depreciations. Question mark.
I'm not quite sure that what you mean by it would offset the depreciation that was
Well, let's
already
just say
taken.
you put in a new roof, you did siding, you did new appliances, you did new flooring, you did, all kinds of stuff or remove popcorn ceiling and, just made it an improvement. Those are costs that would be the opposite of depreciation. So, now you've put those in, so then depreciation on that would start again. So can that offset the depreciation when you're doing your taxes? Because you've upgraded the property.
So it's like deductions versus depreciation. Do you mean?
Right.
I feel like they end up being two separate things, right? Like you have like a new depreciation on the new improvement, then you still have your old stuff that's being depreciated at that
Yes.
rate at that timeline.
But you've increased the value.
Yeah, so you're going to get some
So
depreciations, but it's
depreciation is
based
not
on this.
based, yeah, depreciation is not tied to value, it's tied to cost. So you would continue depreciating the property as it was previously, and then the new improvements would be treated separately and start a new kind of depreciation timeline for those particular assets or improvements.
Perfect.
Hmm.
And I have a
Thank
question
you.
for you, Alicia, while we wrap up. For all the audience here, what's one question every landlord should ask their CPA before this tax season if they haven't filed and before the end of year this year?
Oh boy, one question. Oh, there's so many of them. Um, so the number one thing I would suggest talking with your CPA or advisor about is your overall strategy for how long you plan to hold this property. Oftentimes there are assumptions that are made regarding depreciation and new assets that may not be the best if say you plan to sell it soon or something like that. So make sure you're talking about that kind of long-term plan early on to make sure that everything aligns correctly.
Perfect. So with that, as we wrap up, I want to thank Olivia again for walking us through all of this. A lot of tonight's content comes down to one idea. Real estate tax strategy works best when it's proactive, not reactive. So if you take away a few things from this afternoon, rental losses don't always work the way people expect. Timing matters more than most investors realize, and coordination between your advisors can make a real difference over time. Our goal wasn't to turn anyone into a tax expert this afternoon. It was to help you better understand the landscape so you can plan intentionally and avoid surprises. And we'll be sending out a recording of this session along with a few helpful follow-up resources. And if any questions come up after today, totally normal. We're happy to help you out and point you in the right direction. So whether it's operations, planning, or tax strategy, the best outcomes come when professionals communicate and investors stay informed. And hopefully your next tax conversation starts with, I expected this, instead of, how did this happen? So thank you again for your time. We truly appreciate it. Have a great rest of your day, and we hope to see you in a future session.
Okay, so I hope that was helpful and you got some good nugget out of it. And if there is anything that we can help you with or any advice you need in terms of your property, or if you want information on the Wendroff group, I'm going to put that in the show notes below and you can certainly contact them as well. But we hope we can continue to bring value like this to all of you, our clients, and the general public, and just make you aware of different things and things you can take advantage of, in this case, related to taxes. So thanks for watching. Take care. See you next time.